Hello, everyone. Welcome to another episode of the Eitel Insights podcast. We've got your podcast host, Andy Park. And with us, as always, we've got our founder and lead analyst, Dane Eitel. How you doing, Dane?
Excellent, Andy. How have you been?
We're doing great. So we've just got new data that's come out for the month of September.
Correct.
Yeah. We're going to talk about the detached market today and give everyone a bit of an update. So in our last few podcasts, we've been talking about trends. We're not going to talk too much about it just because we're going to assume you've listened to it. If you have not, go check them out. Subscribe to the channel. Give us a thumbs up. But we've had a little bit of a mini aberration, but maybe you can talk about it. Are we still on track for what we've been talking about, or are we going to change course a little bit?
Yeah, absolutely. For the detached market, let's just get into the new data, first of all, for the detached price. That'll be on your screen here. It's the actual sale price for September for the detached market of average sale price for Greater Vancouver was $1,507,474. So where that puts us technically, speaking on the chart, again on your screen, is right near that lower third of this market cycle, right? And now why that's important is, it's right around that 10-year uptrend. It's definitely broken that 1.625, which is indicated by the yellow middle threshold. So, it seems like 1.48, 1.50, right around there is trying to hold again as this new bottom. That's actually not going to occur. As you've said in podcast previous, we believe the market's going to probably take a leg lower here in first quarter of 2020, ultimately probably bottoming in 2021 for the detached market of Greater Vancouver average sale prices. So, and of course, each city's independent, and we offer those reports through the website. But what we offer here is that overall sentiment of Greater Vancouver. How's the real estate market doing? It's very much going lower longer again. Where we're at right now with the prices is a stress test mitigation, as we've kind of said again in previous podcasts. Now, that signals that, those that were forced to the sidelines can still purchase, and we're seeing some evidence of that with this kind of tight sales range right around, negative 17% to negative 15%, right in that range. So you have a little bit of a cluster of built up demand. Once that dissipates, again, we go lower longer, right? So technically speaking, we're expecting this to possibly even happen quicker than 2020 first quarter, right? Mm-hmm. So, if it goes down to 1.4 in the next month, that wouldn't surprise us too much. That would be the first test of this lower end range, given a normal cycle. Yeah. If that market doesn't hold here throughout of 2020 and 2021, then we have to go lower yet again. The question is, where does the market stop? Well, that would enter into the previously established prices, and that would bring us down to 1.225, which we haven't seen since basically 2015, which is interesting.
Interesting. So if we do hit this 1.4 sooner rather than later, we've kind of talked about the negative implications of that, in that we could go even lower. But is there a chance that once we hit 1.4, we might see a stark rebound and we might see a bit of a jump up?
That's absolutely what's going to happen for the short term. The technical lines are there for a reason, right? 1.4 will be hit, and yes, we'll probably see a dead cat bounce where the market rebounds up to 1.480, 1.5. And then we'll see a leveling out of that. Of course, we're still going lower until a certain price point, and then the trends will start to change. The data will actually start to buck that trend, and you'll see a new trend instigate. Right? Yeah. We're still very far away from that actually occurring, and I think later we're going to get into some of the actual impact of what this means to you as a homeowner being lower. $360,000. Right? It's some serious money.
Okay. Actually, if we can kind of redo the scheduling of our podcast a bit, I'd like to actually touch on that now, because that's a perfect segue. So we've actually been getting a ton of emails on this particular topic, and I think a lot of the momentum that Eitel Insights has built and a lot of the messaging that's gone out to the public has made people be introspective and start thinking about what this means for their own personal financial situation. So one thing that I hadn't even considered until I saw these emails is, what about Joe Schmo that's bought a property right at the peak at $1.8 million?
Right.
He's taken out a giant mortgage to finance that, and then he wanted to do some home renos. So he's taken out, he's used his equity value that he's built up, gotten additional loans to do his renovations, and let's say his mortgage renewal is coming up, sometime in 2020, but all of a sudden my house is worth, what, $300,000-$400,000 less than it was, and it might go down even further.
Right.
Have I described that reality
close?
Accurately?
Very, very close. The dates, the years are a little bit off. So I mean, if we're up for renewal here in 2020, you bought in 2015. And what makes that actually very interesting is in February of 2015, the prices were $1,405,000, right? So effectively, if you bought in 2015 and your mortgage renewal is up in 2020, you're basically equal. So in that scenario you just painted, let's say you bought in 2015, the market was still going up. It was still appreciating for a period of time. But yes, there was renovations. There was maybe a new car because he bought so smart and equity's going up.
Got all this free money.
Life's good,
exactly,
right? Yes, the trend has changed. So yeah, I mean, literally if you got to start thinking about it now, because 2015 and 2020 will be very similar in prices, if not a little bit lower, depending on when you purchased and what kind of house, right? So yes, the real life impact of that is going to actually be felt here coming up next year. And then we go forward another year to your point of buying right at the peak of 2016. Again, May of 2016 was average sale price in the detached market of $1.830 million. In September, or anytime throughout 2021, we're at the best case, we're at 1.4 million throughout that kind of timeline before we break these downtrends. Well, that's a $430,000 equity loss. So if you're up for renewal in 2021, please start getting your affairs in order. I mean, it's going to be a realization that you're either going to be into foreclosure proceedings or you start doing the right things now so that you can get ahead of it. Does it necessarily mean sell the property and get out of Dodge? No. You know what I mean? But you don't know what the future holds for you until you purchase one of our reports, and we guide you to how far has your market already gone down, what's expected to go down further, so you can have some guidance going forward as to what's going to happen at your mortgage renewal meeting. You know what I mean? Because it shouldn't come as a shock, but it's going to come as a shock to a lot of people that bought in 2016 and go up for renewal, and they go, well, what's my value of the house? Like, holy smokes, that's a lot lower than what I thought it was. And the bank will work with you. They don't want to foreclose on too many properties, but there will absolutely be foreclosures in the future here in 2020 and of course 2021, which is it's a sad factor, right? But people have literally moved into their property. The market went up another 200,000. They go, that's my money, and it is your money. But when the table comes back and they say, okay, what have you done with the equity? Well, I used it. Well, now that equity is no longer in the property. How do we make up for that, right? And they'll have conversations with you and try and figure it out. But if you did that times 2, 3, 4 properties, there's probably not too much they can do with you other than foreclose on 2 or 3 of them, right? Now, there is some ways that we advise our clients to mitigate some of this downside. And again, that's what we offer, right? But as far as the public, this is going to be a reality here. It's going to start getting tougher. The banks are already, a little bit more restrictive from the government standpoint with the stress test, which was unheard of. And now this is a reality. So the banks have a natural excuse to kind of pass the buck on why they're not giving you the good mortgage rate or the renewal term or however it is, because their hands are tied. You'll see the kind of private equity, some tertiary markets open up for some mortgage here at higher, of course, interest rates, but that might be the only way that you get to keep your property. So the reality is not going to be pretty, but our position is always that we'd rather be an eagle soaring over and looking at the scenario that we're about to land in, rather than the ostrich with the head in the sand and you just look up and there's a team picture in front of you. That's not what we want for our clients or for anybody. So having information going forward, and again, our reports offer the forecast. It's not just what's happened. It's here's where we are. Here's how far off the peak where we are. Here's where your individual area is actually going to bottom, and when's it looking to rebound. And how do you take advantage of that? Is your personal modus operandi, right? Are you looking to purchase? Are you looking to sell? Are you looking to just keep your ass, right? So I mean, there's a lot of different thoughts going through this market, and we really do cover all of them.
Right. And I mean, this is obviously not us fear mongering here. This is the reality of the situation, right?
Yeah, exactly.
And,
I mean, like we say, prices in May 2017 and 16 were 1.830. Now we're down. That's 330 grand gone. We're going down to 1.40. That's 430 grand gone, and that's the optimal scenario. Again, if we don't hold 1.4, it's 1.225.
Right.
It's not me saying this. I mean, people can suggest that this is our hope and our dream. We did call the top of the market when it technically broke it. That's how we analyze markets, is using scientific analytical interpretation, right? We use studies and hard interpretive studies. We get the data, we use analytical indicators to project the forecast, and then it is a bit of a gift and a bit of some hard work and a lot of studying, a lot of charts to see how this technical line has been broken. What's the reaction? And through that, we've offered guidance that have been to the good of 360,000 so far. So it's not fear mongering; it's reality. And had you purchased our report, maybe it saved you from purchasing at the wrong time, or maybe it helped you sell at the right time. That was back in 2016-17 when we were first to the market. Now that we're very proven, I mean, there's still other analysts saying buy now, buy now, buy now, because you got a 20-year outlook. We'll say, I mean, we'll give you a better outlook in 6 months from now, in a year from now, in 2 years from now. And it's actionable intelligence that we offer through scientific research, for sure.
For sure. And from the perspective of the buyer, you mentioned that there is a possibility that foreclosures might start happening. And if you actually look at some of the peer-reviewed literature on the housing crisis in the U.S., they found that there was a bit of a cyclical phenomenon happening in that, as there were more foreclosures during the economic crisis, there was obviously a dropping of the price. And because the dropping of the price and prices were dropping, that was negatively affecting sentiment. More people were starting to foreclose, and it became this vicious cycle.
Right.
So from a buyer's perspective in Vancouver, is there any value to waiting till the first few foreclosures might happen? So you might see a deceleration of these prices, or do you just think that the buyer should stand by Eitel Insights philosophy and just time it properly sometime around 2020 and not be too worried about looking at the number of foreclosures that are happening?
It depends on what your goals are. If it's a personal property, and yeah, I mean, let's just be realistic here. Prices are down 17%, right? So you're not purchasing at the peak. If you have to buy, you can go ahead and we'll give you a blessing. We'll still give you guidance as to maybe, let's say if it's North Vancouver, here's this, it's X percentage still anticipated drop coming to the market. So now it's up to you whether you wait and see that and you realize that loss, or you go ahead and purchase your property because you need to buy. Mm-hmm. If this is your investment, yeah, I mean, definitely consult us. We'll consult with you and give you our expert guidance that has helped out, right? Just one little clarification again. The detached market is 2021 for the bottom, right? That's where we see this technical line actually breaking given time, right? Okay. So 2020 is when we're definitely gonna test the 1.4 price threshold, which would have held as the bottom, and that would have been a glorious, very anticipated time. Mm-hmm. However, this overarching theme of real estate equity in Vancouver is a bad thing, or whatever the rationale is, there's vitriolicness against the real estate market, right? So it's not a usual cycle, and there has been precedent, right? I mean, we do this research for many decades, not just the last 2 or 3 years, right? So the decades ago research shows that a 31% recession isn't abnormal. Is it normal? No. Is it impossible? Absolutely not, right? It is possible. It's not the normal market cycle. The normal market cycle, given the last 20, 30 years of real estate in Vancouver, is on average, you got about a 3-year selling range and then a 2-year growth cycle, right? 3-year selling range, 3-year growth cycle. In the 90s, we experienced a 6-year market retrenchment and cycle. That's similar to what we're into now, right? Mm-hmm. During the 80s, you had that real sharp increase in prices, then you had the interest rate spike, right? And then you see the market fall right off. That could potentially be the next market cycle and what happens in that. And that's kind of an interesting topic as well, not to get too far off topic, but the interest rates being so low right now, everyone says buy. But they're not changing overnight. And even that new normal is no longer 11% like it was during the 80s. So, and effectively, that was a doubling of the interest rates from 11, 12% up to 21%, right? So that was what killed the market during that period of time. In this new normal of such low interest rates, all you would really need to see is a 7 or an 8% interest rate, and that's an effective double to the market, right? So we're never probably going to see 21% interest rates again anytime during our lifetime, but the potential of a 7 or an 8% could be there if we see a recession now and then a boom after, which again is cyclical through time. So sorry, not to, like I say, get too far off topic, but yes, the buyer, it depends on your motivation. If you have to buy, we'll give you our blessing. We'll give you the report. We'll offer you guidance as to where it could potentially go. Some markets don't have too much further to go. I mean, as we say, we're getting closer to this. We're closer to the bottom than we are to the top, right? So, but yeah, there's definitely advantages to waiting, more so than to putting all of your eggs in a basket right now. Absolutely, in the detached market.
Okay. But you're not willing to reveal the market versus foreclosure specifically until somebody buys a report.
I mean, the foreclosure market, we can offer guidance as to how many are going to be in a market, but that's not really what we offer through the reports. It's this market's going to be at such lows, the chances of there being foreclosures would be quite high. Right.
And then individually, if you want to pick one up, then
absolutely. And a foreclosure is an interesting idea. Idea, because when people hear foreclosures, they want to invest.
Yeah.
Well, and that's kind of a known signal.
Yeah.
Our reports will alert you to it probably much before then, and you'll be in on one of the earlier foreclosures rather than Johnny come lately when there's actually 30 people in the courtroom waiting to bid.
Right.
I've been in real estate for a long, long time, and I remember the 08-09 recession. Yeah. During the beginning when I had a listing from the bank, we had one seller or one purchaser. He showed up to the courtroom and we sold it. I got on a track of selling a few of them. By the end of that market cycle, during the later parts of 09, those foreclosures, we saw bids galore.
Right.
So that is that market cycle. Yes, is it going to be horrible the first few times and nobody wants to touch a foreclosure listing until about, 9 months, a year later, everybody wants a foreclosure listing because all of a sudden they're selling fairly fast. Right. So again, our technical analysis shows you where the market's going. It doesn't give you a fundamental rationale. It doesn't give you a name as to, it's this reason, it's the government change, it's this. We show you charts and then all of a sudden the fundamental rationale shows up, which is the interesting thing of technical analysis, right?
Yeah, exactly. And that's what kind of interests me about it is it's phenomenon-driven research. So, but we are running out of time, Dane, but I did want to touch on our last two topics.
Sure.
We've spoken about the latest price data. Can you quickly touch on sales and inventory and whether anything surprising has happened there?
Yeah, really, we're kind of status quo here with the inventory. We're right at 5,970 listings, basically in the middle of the uptrend. We'll put that chart up here for you right now. As you can see, it's growing. There wasn't too much movement month over month, and that's not surprising. Would expect to see a little bit of an uptick here in September because of that stress test mitigation that there have been some purchases, and so you'll see more listings. You'll see probably sharper price listings come to the market, and you'll see the other listings that just kind of fade by the wayside. They continue to grow in days on market, which leads to a new listing. If there's a 90-day market or house on market, and then a 75-day house on market, and then a 34-day house on market, all around that same price point. If I meet you as a seller and I say, well, these ones aren't selling, and it's no longer the day of, well, your house is so unique, it's going to trump this, unless it truly is unique. So you'll list that 10 or 20 grand lower just to separate yourself strictly on price, because there is no really other separation between the properties anymore. And so you'll see that kind of continue to grow where, yeah, the stagnant listings are truly stagnant, and unless you do a price reduction, you're just going to stay on the market, and the new ones will start to go. And then you'll have that reaction after it drops significantly in price. The sellers will say, "Well, shucks, I should have listened and listed at 50 grand lower than where I was, because now I'm at 75, 80 grand lower than where I was last year." Right. So that's kind of how the inventory kind of shakes out. Yeah.
Okay. Cool. We've gone through a ton of data here today.
We've still got the sales. I think we got to go.
Oh yeah, sorry. Okay, yeah, we've got sales. Sorry.
Yeah. No worries. Okay. So yeah, the sales. We're right in the middle. Kind of it seems to be setting up a new selling range in this sales where we're topping out right around that 930 mark that we mentioned last time, which is that green line here. Again, it's on your chart or on your screen. And so that seems to be our kind of new height of sales. 755 sales in the month of August. Right in that middle, we're kind of seeing maybe a bottoming right around that 600 mark, and that's going to be interesting. We could also potentially be setting up for a new uptrend to test this orange line downtrend. We're going to have to wait for the next couple of months to actually see how that starts to play out. But yeah, sales are happening. They're not at a feverish pitch by any stretch of the imagination. You do have to separate yourself. You do have to be negotiable. You do have to be open to offers. And you know what's odd? This market going forward is going to get more and more kind of outside the box thinking. We're going to see maybe even some real estate trades start to happen, kind of alluding back to the interest rates maybe going up over this next decade or so. I can actually start to see maybe over the next 2 or 3 years people purchasing 10-year mortgages. And then that coupled with the fact that interest rates could be going up, you could actually sell your property with that 10-year mortgage, and you just assume the mortgage from the seller, and that's at a different interest rate. So there's a lot of different ways that real estate used to work, and then it became very lineal. You give me the cash, I'll give you the house. Give me the cash, I'll give you the condo. Give me the cash, I'll give you the townhouse. It could actually start to revert back to some more interesting deals start to take place. As long as they're legal, we'll support the contract, right? That's another interesting thing about real estate. Whatever's written inside a contract, I mean, it's basically legal, right? You can't have a contract within a contract, but there's a lot of different ways to make that contract work for both sides. And I think that'll start to become more prevalent in this new real estate market that we find ourselves in, going lower longer again in the detached market till likely 2021. We have some very interesting data that just happened, and I expect it to probably continue over this last quarter of the year and the first quarter of next year, and we'll probably have a lot to talk about over that period of time.
All right, perfect. You heard it here first. Today was an interesting one. We had a data-driven talk, and then we waxed philosophical on existential real estate issues as well. So if you like this podcast episode, give us a like, give us a thumbs up, and subscribe to the channel, and we'll see you on the next one.
One other thing I will add, maybe if you guys have similar-minded friends, or if you're on Facebook or any of that, feel free to give it a share. We don't, we don't hide our content. It's out there to be heard. So share it if you feel like it.
Yeah, and that's what I meant when I said like it and thumbs up. I meant like it and share it. Okay, we'll see you on the next one. Take care.